This timeline charts the volume of global financial data leaks over the past few decades. The data remains relatively flat until a spike in 2017, representing the 13.4 million leaked files known as the Paradise Papers. Included was the revelation that Apple held $252 billion in offshore accounts, shielded from domestic taxation. The disclosure triggered protests at Apple stores across Europe, with activist groups demanding the company pay its localized tax burdens. Regulatory bodies faced sudden public pressure to intervene in international wealth hoarding. These files implicated more than just one firm. They unmasked a systemic reliance on offshore shelters by the biggest tech companies, including Facebook, Google, and Microsoft. The leak suggested that moving profits through secrecy jurisdictions had become a standard operating procedure for the Western corporate elite. The 2021 Pandora Papers exposed a geographic shift in offshore wealth. The data leads directly to the United States, highlighting financial trusts in South Dakota, Florida, Delaware, and Nevada. In South Dakota alone, customer assets quadrupled over a single decade, reaching $360 billion. The mechanics of these leaks became so prevalent they entered pop culture. The Netflix film The Laundromat, starring Meryl Streep, was built around the money-shielding tactics exposed in the Panama Papers. The United States has established itself as one of the world's most powerful tax havens. Domestic trust systems have replaced traditional tropical island shelters. This flowchart outlines the mechanics of the system, starting with the flow of money between a parent company's subsidiaries. An operating company, Irish Company 2, needs to transfer its royalty profits to Irish Company 1, an entity registered in Bermuda where the corporate tax rate is 0. If the operating company wires those royalties directly to Bermuda, the Irish government applies a withholding tax penalty of up to 20% on the transfer. To bypass this penalty, a third country is added to the flowchart, creating the Dutch sandwich. The royalties are routed into a holding company in the Netherlands, which then sub-licenses the payments to Bermuda, circumventing the Irish roadblock. This structure complies with the letter of the law while subverting its intent. Corporate tax lawyers effectively outmaneuvered national regulators by using localized tax treaties against them. This historical line chart tracks the actual financial movements of Google, applying real-world data to the theoretical Dutch sandwich flowchart. The data spike in the year 2016 reveals the efficiency of the tactic. In that single calendar year, Google shielded $19.2 billion by routing it through a Bermuda shell company. Data from the Dutch Chamber of Commerce confirms this transfer was 7% higher than the amount moved the year prior. This systematic extraction of capital caused geopolitical friction. European lawmakers faced shrinking public budgets while watching taxable revenue legally exit their borders. A single corporate maneuver can drain more wealth from public economies than the gross domestic product of entire nations. These administrative loopholes extract a measurable toll on global infrastructure. Intense political pressure from the European Union eventually forced Ireland to close the double Irish structure, barring any new companies from adopting the loophole in 2015. This timeline graph tracks the legacy phase-out of the scheme. By the end of 2020, legacy users were forced to abandon the structure, and the usage line hit 0. This scatterplot visualizes data generated from 2026 Financial Accounting Standards Board disclosure requirements. These rules were designed to pierce the corporate veil, forcing public companies to break down exactly where they book their profits and pay their taxes. Closing the double Irish merely forced global tax avoidance to evolve. The new FASB data proves the system responded by developing more complex, localized structures that are harder to trace. To counter this evolution, global policymakers negotiated Pillar 2, an international agreement designed to establish a universal minimum corporate tax and end the global race to the bottom. But just as this system was meant to solidify, a massive void opened at the center of the global financial map in January 2026. The United States Department of the Treasury officially announced a regulatory carve-out, declaring that U.S.-headquartered companies would be exempt from the Pillar 2 requirements. The United States government now functions as the primary tax haven. By exempting its own corporations from the minimum tax, the U.S. ensured that multinational corporate wealth remains untouchable. Analysis of the precise distribution of hidden wealth reveals a staggering baseline of global secrecy. In Europe, 10% of the continent's total wealth is held in offshore tax havens. In Africa, that figure spikes to nearly a third, while in Russia, half of the nation's total wealth is concealed in offshore accounts. The most extreme outlier sits at the top of the chart. 63% of all foreign profits generated by United States multinationals are shifted directly into tax havens. These figures reached the public through a sequence of massive disclosures. The 2017 Paradise Papers exposed the offshore holdings of the corporate elite, while the 2021 Pandora Papers unmasked the real owners of 29,000 offshore companies and over 100 billionaires. Those records also shifted the geographic focus to domestic shores. The offshore system is highly active within specific U.S. states, notably South Dakota, Florida, Delaware, and Nevada. The financial growth in these hubs has been explosive. In South Dakota alone, the value of customer assets held in local trusts has quadrupled over the last decade, surging to $360 billion. The traditional image of an offshore haven is obsolete. Today, the most lucrative secrecy jurisdictions operate in plain sight within the world's largest economies. To see how these billions are mathematically erased, we have to look at a structure known as the double Irish with a Dutch sandwich. This mechanism requires two distinct corporate entities, Irish Company 1 and Irish Company 2. This strategy relies on a legal residency trick. Irish Company 1 is incorporated in Ireland, but its management is based in a tax haven like Bermuda, which carries a corporate tax rate of 0%. The parent company transfers its intellectual property to Company 1, which then licenses it to Company 2, the entity that actually conducts business with European customers. Company 2 then pays massive, artificial royalties back to Company 1. These payments are set so high that they strip out almost all taxable profit from the operating company, moving it to a jurisdiction where it can accumulate untaxed. This chart tracks the historical financial movements of Google. In 2016 alone, the company moved $19.2 billion to a Bermuda shell company using this exact structure. Facebook used a parallel strategy, avoiding an estimated $15.8 billion in taxes during 2018. The mathematical floor of this strategy is visible in Apple's effective tax rate, which plummeted to just 0.005% on European profits. Following an investigation, the European Union issued a historic recovery order for 13 billion euros, roughly 14 billion US dollars. These corporations utilized precision engineering to exploit legal mismatches between different nations. Their success eventually forced international regulatory bodies into an aggressive crackdown to reclaim that revenue. That pressure resulted in the official phase-out of the double Irish scheme, with the European Union successfully forcing its closure by the end of 2020. But closing one loophole often forces capital into new structures. 2026 financial disclosures show that just 40 U.S. multinationals recently saved over $11 billion through offshore havens. Pharmaceutical giant Merck, for example, leveraged favorable corporate rates to pay $2.1 billion in taxes to Switzerland rather than booking those profits in the United States. The current global response is a safety net called Pillar 2. It uses a specific formula to calculate a company's effective tax rate on a jurisdiction-by-jurisdiction basis, ensuring that taxes are paid at a minimum of 15%, regardless of where profits are booked. While much of the world has adopted this framework to stop tax migration, the United States has opted out. This creates a significant structural tension, as the world's largest corporate sector remains outside the very system designed to capture its missing revenue. A similar anomaly is visible in India's economic boom. Between 2000 and 2012, 39% of the nation's total foreign direct investment did not come from traditional financial powerhouses. Instead, over $63 billion flowed directly from the tiny island of Mauritius. This is the result of round-tripping. It involves routing domestic wealth out of the country only to bring it back disguised as foreign investment. This circular journey allows the capital to qualify for the legal protections of the India-Mauritius Tax Treaty. The math of this strategy is highly lucrative. If an investor routes $10 million through a Mauritian shell company and it grows to $30 million, the treaty bars India from taxing the $20 million gain. Since Mauritius does not levy a domestic capital gains tax, the profit is repatriated entirely tax-free. For years, Indian tax officers were legally blocked from investigating these entities. Administrative rules mandated that a simple certificate of residence from the Mauritian authorities was final evidence of tax eligibility. In 2003, the Supreme Court of India held that utilizing a legally ratified treaty for tax planning was lawful. The Azadari Bachao Andolan judgment affirmed that a taxpayer's underlying motive, even if it was strictly to avoid tax, did not render the arrangement void. The ruling provided the legal certainty needed for the Mauritius route to become the primary highway for capital entering India. To regain control over these assets, the government eventually had to deploy the General Anti-Avoidance Rule, or GAAR, which gives tax authorities the specific power to disregard arrangements that lack commercial substance. Looking at the entire architecture of wealth creation covered in this series, it becomes clear that these disparate strategies share a common structural lineage. Borrowing against a fixed deposit uses the same mechanical logic as a multinational routing royalties through a Bermuda shell company. The underlying physics of jurisdiction and deferral apply whether using a local 1031 exchange or executing a circular, round-tripping conduit. These aren't accidental failures in the law. These mechanisms are the intended results of a system operating exactly as mathematically and legally designed. Access to these institutions is defined by law, but utilizing them requires mastery of their mechanics. In the modern economy, the primary gap between the individual and the global elite is an asymmetry of structural financial knowledge.